This is a BC Eagle accounting video. Mother Nature preempted the quiz that we were going to complete on Thursday, November 15th. So here is a video of the solution to the quiz, and we will do a brand new one very similar to this one on Tuesday, the 20th. Problem number 1 said that you had the Pfister Links product bought a Microsoft bond on July 2, 2018 for a cost of $447,674 to yield an effective percentage rate of 5%. These bonds had a face value of $500,000. The bonds pay semi-annual interest on January 1 and July 1, and have 15 more years outstanding. Because these are semi-annual bonds, there will be 30, 15 times 2, 6-month periods in 15 years. The bonds carry a 4% coupon rate, which would be based on the face value of the bonds. On the date that the Pfister Links products bought the Microsoft bond, Pfister Links products appropriately classified these investments as available for sale. That means any unrealized gains or losses will be reported through other comprehensive income rather than earned income in the first part of the financial statement. The bonds had a fair value of $445,320 on December 31st, 2018, and had a fair value of $443,187 on December 31, 2019. Because these are considered to be available for sale securities, the balance sheet, according to U.S. GAAP, should report these bonds at their fair value at the end of the year. Our charge is to make the journal entries that the Pfister Links Products Company would make in regard to these Microsoft bonds on July 2, 2018, the purchase date, on December 31, 2018, the end of the first year, and then to make all the entries necessary for the year 2019, and then finally show how Pfister Link would show the Microsoft bond investment on its balance sheet at the end of 2019. The first entry is to record the bonds on the Pfister Links books on July 2, so we would increase the investment account by $500,000 and then show a discount of $52,326 to equate the face amount to the cash that was actually paid, $447,674. Accordingly, we would post this entry to the appropriate ledger accounts, $500,000 to bonds, $52,326 to the discount account, and of course cash would also be credited, and that account is not shown here. The entry on December 31st is necessary to accrue any interest revenue that the Pfister Links company would earn. In this case, any bond that we have would need to have an amortization schedule. This goes true whether the bond is held to maturity, whether it's considered a trading security, or whether, like this one, it is an available for sale security. So in completing the amortization schedule, we can show a date, and just to keep us straight, the number of periods. The interest revenue is based on the yield to maturity rate, 5% divided by 2, that would be 2.5% every 6 months. And then the coupon rate that the bond pays would be 4% annual rate divided by 2 semi-annual periods a year, or 2% every 6 months. The difference between the interest revenue and the coupon cash received would be the amortization of the discount. So let's, and we also show the discount balance and then the carrying value of the bonds. So the original entry at time 0, July 2, 2018, would show a carrying value, the purchase price of the bonds, of $447,697, and then the discount balance of $52,326. And of course, these values would come straight from the general ledger account, $500,000 for the bond, less the original discount, $52,326. That would produce the purchase price of $447,674. Continuing on, the amount of interest expense is based on the beginning of the year carrying value. So $447,674 times 2.5% would produce interest revenue as of January 1, 2019 of $11,192. Coupon interest is determined based on the face. The face amount of the bonds would be $500,000. So $500,000 times 4% times 6/12 of a year would give us $10,000 as the coupon cash that the business would receive on January 1. The difference between interest revenue and coupon cash would be the amortization of the discount. So the previous discount on July 2, 2018, period 0, would be $52,326, less the amortization, $1192, and that would give the remaining discount balance of $51,134. $51,134 taken from the face amount of the bonds, $500,000, would leave the carrying value at the end of the year 2018 at $448,866. Now, let's make the journal entry from this. The journal entry at the end of 2018 should show interest revenue of $11,192. Because we are making an entry at December 31, 2018, and this cash hasn't been received yet, the record should show a debit to interest receivable instead of cash at 12/31/18. And then we will have a debit, a reduction to the discount of $1,192. Okay, let's take a look at the entry. Interest receivable will be debited for $10,000. The discount on bonds and bond investment would be debited $1,192, and the difference would equal the interest revenue, $11,192. And you can see these values correspond to the values that would be on the amortization table. $10,000 for the interest receivable here, $11,192 for the interest revenue here, and then the debit to the discount, $1,192 here. Accordingly, these amounts would be posted to the discount account as a debit. The amount of the discount reduction from the beginning of the period balance would give us an end of the period balance of $51,134. Continuing on with the amortization schedule, we would just proceed through the next two periods, 2019, in the same way. The interest revenue for the investor would be the previous period's carrying value of the bonds, $448,866, times 2.5% to give $11,222. The face amount of the bonds, $500,000, times 2% would give $10,000 of cash interest received. The difference between the interest revenue and the coupon cash gives the amortization. 12/2 from the $51,134 remaining balance produces a balance on July 1, 2019 for the discount of $49,912, and then $49,912 from $500,000 face gives the carrying value on July 1, 2019 of $450,088. Continuing on, $450,088 times 2.5% produces the interest revenue as of 1/1/20. 500,000 times 2% produces 10,000 coupon interest, and the difference between the revenue and the cash received would be amortization of the discount. This discount amortization from the beginning of the period balance, 49,912, will produce an ending balance at January 1, 2020 or at 12/31/2019 of 48,660. The carrying value, the amortized cost of the bond, would be the difference between 500,000 and the remaining discount balance, 48,660, or $451,340. Okay, so let's make these particular journal entries. Again, the journal entries can be taken directly from the amortization schedule. Let's go back to the end of 2018. The fair market value of the bonds would be $445,320, but the carrying value of these bonds as of the end of the period are $448,886. So we will need to make an adjustment to the fair value based on the amortized cost, $448,866, and the reported fair value, $445,320. So to do that, obviously you can see that the fair value of the bonds, $445,320, is less than the amortized cost. So that means that interest rates must have increased since the bonds were purchased, and this company will show an unrealized loss in the difference between the fair value, $445,320, and the amortized cost, $448,866. That difference is $3,546. Debit the unrealized holding loss that goes through other comprehensive income, and credit the fair value allowance on the bond discount. And this credit then would be posted to the fair value allowance account. Finishing up 2018, we know that the interest receivable was at the end of the year, and then on January 1, the date that the bonds do in fact pay interest, the company Pfister Links Products would receive cash of $10,000 and reduce the interest receivable $10,000 to clear the receivable at the end of the year. On July 1 of the next period, you can see that we want to have $11,222 of revenue and amortize the discount $1,222. So the journal entry on July 1 would be the receipt of cash $10,000, a reduction of the discount $1,222, and an increase in interest revenue or investment revenue, either one would be fine, $11,222. And finally, at the end of the period, we would do something similar. We have $11,252 based on the 1/1/20 next coupon rate, $10,000 of cash, and a further amortization of the discount of $1,252. So the journal entry at 12/31/19 would be an increase in interest receivable because this cash won't be received until 1/1/20. Amortization of the discount, debit it $1,252, and then finally record interest revenue $11,252. At the end of 2019, the bonds are worth $443,187 in the open market. So again, the amortized cost of the bonds is more than the fair value. So these bonds, again, have further lost money. So what we need to do is to consider what the previous balance would have been in the bond adjustment account. And so that would be the original $500,000 face, less the discount, the amortized discount as of the end of 2019. And we would need to post the $1,222 of amortization for July 1, 19, and the third 6 months amortization, $1,252 at December 31 to the investment discount account. So the 12/18 balance less the two amortization amounts in 2019 produce an ending balance in the discount account of $48,660. Additionally, at 12/31/18, we have a balance in the existing fair value allowance account, a credit of $35,046. So that also will be deducted from the face value of the bond. These three items together means that we have an existing carrying value of the bonds on the balance sheet of $445,320, and the difference between these two is going to produce the adjusting journal entry. We want a balance of $81.53 in the fair value allowance account, which would be the $443,187 less these amounts here. And that means that we need an ending balance of $8,153. Let's just take a minute and look at that calculation in a little bit more detail. The fair value of the bonds that are being carried on the books now would be $500,000, the face value of the bonds, less the discount, $48,660, less the fair value allowance, $3,546, and that means that the previous carrying value would be $447,794. That's the amortized cost and fair value at 12/31/19. And let's compare that to the $443,187 fair value. And doing the calculation, that means that we will have a $4,607 additional loss, note the minus sign, that is appearing in the unrealized holding loss as of 12/31/19. So debit the unrealized holding loss, credit the fair value allowance in the bond, the $4,607 added to the $3,546 previous balance gives us the ending balance at 12/31/19. So there you have the journal entries doing the balance sheet. We still have a receivable balance at 12/31/19 of $10,000, so that would be a current asset accounts receivable. The investment of the bonds, the net of the bond investment account, the amortized balance and the discount, and the fair value adjustment, subtracting or taking the $500,000 and subtracting the discount and the fair value allowance gives us the total fair value, $443,187. That would be shown under the long-term investments on the balance sheet. And finally, there would be a balance that would be an owner's equity equivalent to the fair value allowance account. This would be the accumulated other comprehensive income. This would show up as a debit or reduction in the unrealized portion of owner's equity, debit $8,153. There you have it. That takes care of the first problem that we had on the quiz. In a separate video, we will examine the second investment, which was an equity investment under the equity method. Stay tuned. Do well.